Good evening. Welcome to our webinar around strategies to get mortgage free. Exciting day with a 50 basis point drop in the OCR at last. Definitely called for, but we are going to talk about that in light of your mortgage strategy and the things that you should be thinking about if you've got a fixed term rolling off or you are looking to execute on some investment strategies. Let's keep that in mind as we go through this webinar tonight. I'm going to talk for about 45 minutes in terms of strategies. Thank you so much for submitting fantastic questions prior to the webinar. There's still a few people coming through. If you have any questions or you want clarification in terms of anything I discussed tonight, there's a wee question box, and my lovely producer Amelia will compile those and we'll go through them at the end with the questions that you've already submitted. So it is an important day. There is lots to cover off. So let's dive in. And as always, just a wee disclaimer before we go into the bulk of the presentation. This presentation is provided for information purposes only. The content of this presentation is not intended as a substitute for regulated financial advice. If you want to dive a bit deeper in terms of your own strategy, if you're a client of Enable Me already, welcome. Please reach out to your coach. If you are not yet a client of Enable Me, really encourage you to take us up on the offer that we will be sharing with you this evening at the end of this webinar, if you want to unpack how that relates to your own situation. So who am I? My name is Katie Wesney. My background is I'm a chartered accountant. I trained at KPMG, feels like 1,000 years ago now, and I'm the head strategic coach for Enable Me. So I work with wonderful clients, but I also help coach our coaches nationwide. In effect, you tell me where you'd like to be financially, and I'll show you the quickest route to get there with the least amount of effort. That is me and my role, and I've been doing this for the last decade. There's actually nothing I haven't seen yet. Yeah, love my job and really empowering for people to understand and really take the bull by the horns in terms of what they can do better in terms of their controllables. There is a lot to cover off tonight, and obviously I am peppering this, as I keep on saying, just in the context of what happened today and how that should translate to your own strategy. I talk at pace because I do want to give you as much value as I can in this session. So we're going to cover off why you need to get mortgage free. Lots of people challenge me a little bit how that sits within their overall strategy. So we'll unpack that together. How do you accelerate mortgage repayments? Not about just paying more, if I'm honest. That's generally not what I advise at a very high level. So again, let's dig a bit deeper in terms of that strategy. We'll talk about the 3 Rs, how we see that relates to optimizing your mortgage and why you need a plan to achieve your financial goals. And as I said, we'll round everything out with the Q&A. And we're going to be running some polls. Again, we want to nuance this to the audience tonight. So first poll, are you on track to be mortgage free by retirement? Yes, no, or don't know. So if you can just select that. And if the answer is no, please know that you are not alone. 13% of retirees are still paying off their mortgage. So stats aren't really in our favour. So in terms of the audience, 51% are on track to be mortgage free. Fantastic. 24% aren't and 24% don't know. Okay, great, and wonderful to be on track to be mortgage free. Fantastic. To be honest, that's better than most. But again, there needs to be an overarching strategy around that in terms of what else do you need to be doing as part of that strategy to make sure that you grow your wealth. Having a really great mortgage strategy, I think, is vital to everyone, but it's not the be all and end all. So again, we'll touch on that in terms of what are the concurrent strategies that run alongside a really good mortgage strategy as well. So If you aren't mortgage free as fast as you should, obviously this creates issues for you. You spend more on interest. One of the wonders of personal finance is compounding interest. When you have savings, you earn interest on interest. When you have debt, you are paying interest on interest. So the maths around that is if you have 500K of lending and you pay it off over the standard term in New Zealand, which is 30 years, you repay 3 times what you borrowed. And it is not year 15 that you start paying back more principal than you do interest. If you do that standard repayment, the first 23 years of that mortgage, you're paying back more interest than you do principal with every repayment. Shortening your investment runway pre-retirement. So the longer you're slogging your guts out in terms of paying off a home mortgage means that you have a shorter amount of time to save for retirement. Um, if you leave your run later than you should, it means that you can't tap into the equity that you create by increasing the cadence of mortgage repayment to do something else, like buy an investment property, for example. And you stack more risk in terms of your position. So if you're extending out that mortgage term, you've got a shorter runway to create a good strategy to sort retirement, which means that you have to take on more risk in effect to sort your overall position. And you just don't have enough to live the retirement that you want, and you are retired a really long time. For my clients, I'm determined that they get to live their best life for as long as possible. And often for us with kids, I've got 3 kiddies, really important in terms of making sure we get that balance right in terms of giving our children or empowering our children in terms of what they should be doing, but not at the expense of our own retirement. So it's weighing that up in the context of your plan. Why get mortgage free as soon as possible? Problems we're currently facing. 56% of Kiwis are living paycheck to paycheck. So again, if you're feeling really constrained at the moment in terms of cost of living, interest rates, not alone. 74% of us worry about money. Again, I understand worrying about money. The way you don't worry about money is you have a great plan and you anchor that to action. So that's got what we're going to focus on tonight. 76% of us are concerned about interest rates. And I think as a general rule, as a nation, we are hyper fixated on interest rates. It's fantastic to see the OCR coming down, which will translate to us paying less in interest. But if I'm really honest with you, right from the get-go, paying a lower interest rate is not necessarily the thing that makes this work. It's actually having a great strategy to pay it off. So again, we'll talk to that. Obviously, I want you to pay the least amount in interest, but again, that generally comes down to having a great strategy. 49% of New Zealanders' income is going towards their mortgage. And again, that's just more pressure in terms of if anything happens with your job, someone gets sick, etc. And that's a huge downward pressure in terms of your life and your lifestyle. So becoming mortgage free early, it saves you money on long-term interest costs. Remember we said if you have 500K lending, you repay 3 times. That is a lot of cash flow that's getting soaked up in terms of mortgage. When you are mortgage free as fast as possible, it increases that financial stability. Again, one of your biggest cash outflows. When you don't have to pay it, it feels fantastic. Helps to reduce financial stress, which often causes friction within relationships. And again, it's just more opportunities to grow wealth and help kids essentially longer term. And often, I think one of the biggest risks for us is that for a lot of us, we don't have that refined plan. For lots of us, the default position is we just keep doing what we're doing, but that's often the biggest opportunity cost of all. It exposes you to interest rate volatility. Obviously, we're coming off a interest rate peak in terms of the cycle, that if you don't have a plan and a strategy, that is stressful. It prolongs having that relationship in terms of the bank and the constraints that that might come from having your home mortgage, and again, less opportunities to leverage that in terms of growing that wealth position, and there's an increased risk of retirement savings shortfall. So that's essentially the risks of doing nothing. So that's not going to be us on the call tonight. So let's talk about what we can focus on, which is the controllables around strategy. So again, let's unpack how to execute on that really refined strategy. Remember tonight, I am laboring over mortgage. For my clients, that's just one lever we're pulling alongside other wealth creation tools. It's a really important one, but this is in conjunction with other things. So again, we're just being super hyper focused on that mortgage tonight. So let's talk about your current mortgage strategy. So are you leaning into paying the least amount in terms of you want your mortgage term to be as long as possible to lower your repayments, so you can do other things? Are you always looking out for the lowest interest rate? So your key strategy is when you have fixed terms rolling off, you are making sure that you pay the least amount in interest. Or is flexibility super important to you in terms of your current mortgage strategy? So you've got one choice. So what speaks to you the most there? And in terms of what mortgage rates have been doing, let's take a look at this graph here. So in terms of, you can see that there's cycles. We are coming off the peak of that kind of upper edge of that interest rate cycle. I'm just going to take a moment and have a look at those poll results. So 13% of us are looking at kicking out that term for as long as possible to minimize what we pay every month. I understand that strategy. You're always looking for the lowest interest rate. Yep, again, that's reflective of, I think, the vast majority of New Zealanders is we anchor our strategy on making sure we pay the least amount in interest. It is an element, it is not the be all and end all. And again, we're going to go through that with live examples soon. And 23% said flexibility. When I work with my clients, we effectively weave those three elements in terms of their optimal strategy. So again, we'll talk to that in a minute. So going back to that graph, you can see there are cycles. We're not afraid of cycles. Again, we can control the controllables. You can see with that OCR drop of 50 basis points today, we're in the downward trajectory in terms of interest rates. There are important things to note, though, and I think this is really important to clock in terms of your strategy. So until we get down to 3% in terms of the OCR, we are still in a tightening environment in terms of restrictions in the market. It's still seen that that kind of neutral OCR in New Zealand is 3%. So what does that mean to you and I? It means that there's not inflationary pressure or deflationary pressure. So that's our home base that the Reserve Bank is trying to get us back to. What does that mean to retail customers like you and I? It means that when we get back down to that 3% OCR, what we'll be paying is more like 5%. So that neutral OCR in New Zealand still seem to be about 2.5 to 3%. What we would be paying is more that kind of between 4 and 5%. So that's seen as the kind of long-term average in terms of interest rates. That is very important to clock in terms of your mortgage strategy. So very likely, and I don't have a crystal ball. I would love to have a crystal ball, but I don't, sadly. Um, What does that mean to us is very unlikely that we're going to see those lows that we saw in COVID times of those 2s and 3%. So if you are holding out for that, you might be holding out for a very long time. And if we are back to 2 and 3%, the economy is seriously in the not doing so well. So, not a thing to be hoping for in all reality, because the economy will be in serious strife and you'll have bigger fish to fry, mark my words. You'll be worried about your job or your business. So, very likely that neutral OCR is between 4 and 5%. That's playing into my clients' thinking in terms of their strategy. So, again, not having a crystal ball, but we are seeing at the moment, those 1-year rates drop below 6%. Likely, we still think that early 2025, we'll see those longer term rates drop back to under 5%. And mark my words, for a lot of my clients, as soon as they see a 4, that's going to be really tempting to them in terms of those longer term fixing rates. So, again, that needs to play into your thinking. Important to pay the least amount in terms of interest, but that's just one element in terms of that strategy. Relying on interest rate drops is not the answer to that longer term mortgage strategy. It's just not. We control the controllables, and sadly, we can't control the OCR. So again, let's just unpack that together. Looking at like a 600K mortgage on a 25-year term, paying 6.49%, that's about 4 grand a month. So 4,447, sorry, 4,047 per month. If we get down to 5.99, that equates to 3,862 per month. So again, that's about 20 to 40 bucks per week. I mean, I'll take it. Don't get me wrong. But again, is that going to exponentially move the dial in terms of you and your family and strategy? Likely not. We pay the least amount, but again, we've got to be strategic and optimal in terms of how we drive that strategy. And how do we do that in terms of Enable Me? Is one of the tools that we use for our clients is we have a mortgage optimization calculation written by one of our professors at the University of Auckland that we've patented. Like 8 pages of calculus. Most people's eyes glaze over at this point. But essentially, what it does is it cuts that mortgage into savings or debt reduction goals. So every year you have a piece you can attack over and above what the bank wants you to do on your terms, not their terms, balanced with getting certainty in terms of interest rate with what's left over in the context of your larger plan. But in terms of moving the dial and having the ability to be in a better place around that mortgage, you have to increase the cadence at which you pay it off. It is unacceptable for my clients that they pay it off over those 25, 30-year terms. Unacceptable. But to allow us to pay that mortgage off faster, we have to have cash left over to chuck against said mortgage. So, step one is making sure that you maximize that cash surplus. Cash in, cash out, there needs to be something left over so that you have a chance of increasing the cadence of repayment. And for us to do that, we need to make sure that we remove the inefficiencies in terms of your position. And everyone has inefficiencies. On average, people fritter about 15% of their net income across the country, and that is universal. A little bit of overspending, a lot of paying too much interest to the bank. So, again, having that really refined mortgage structure really helps. And there are inefficiencies everywhere in terms of fritter. For a lot of my clients, a lot of that is around food in terms of groceries. And yeah, I get it. I get it. The cost of living is hard. It's gone up significantly. Again, I've got 3 kids. I feel like I bleed money every time I go to the supermarket, but there are still inefficiencies lurking there. I know. If you go into the supermarket every second day, you're frittering. I already know that. Other things we fritter our money on, utilities, just again, staying with that one provider, not reviewing that regularly, subscriptions, bank fees. But just finding those inefficiencies and again, having a surplus on paper. Yeah, love that tip. Leave the kids at home when shopping. Love it. I totally agree, Andrew. Um, yeah, they are an obstacle for everyone. I absolutely acknowledge that. But yeah, you will definitely spend less. But again, having a surplus on paper doesn't mean that it comes to fruition in terms of reality. I don't know if you've written budgets before, cash in, cash out, you think, oh my goodness, this is going to be amazing. This is going to be our year. And it just evaporates. So I think being intentional is really important, making sure that you do have that surplus, but you've got to have a way to capture that really effectively in terms of that environmental piece. And you've got to make sure you're embedding the right behaviors to stay on track. I use this saying often in terms of my commentary in the media with my clients, but it's so true and it resonates with most people. When it comes to financial strategies, wealth creation, mortgage, 1% is ideas, 99 is execution. Doing the right thing at the right time to make sure that you're maximizing your position. So if step one is making sure that you have cash flow left over, step two is making sure that you capture it and that you're consistently achieving. How do you do that? Again, I've got lots of tips and tricks that I weave into the environment with my clients. Having a really good bank account structure really helps in terms of smoothing out cash flow, um, less regular spending bills day to day, and having a really clear goal that you're striving towards is important. And am I saying be miserable and just focus on saving as much as possible? Certainly not, because I know that doesn't work as well. It's not about, well, how do I pay off my mortgage by sitting in a dark room eating baked beans and living a miserable life? No, it's not. It's saying, well, how do I live my best life? Acknowledging what that costs me to make sure that there's money left over, I can scoop that up and really effectively channel that in terms of my mortgage structure, paying that off as fast as possible, but also my broader wealth creation strategy. So again, we've talked about that bank account structure. Um, not using credit cards will help. It really does. We know that naturally you spend more than you would otherwise by using credit just because it's a less transparent form of payment. Often tracking your spending super useful. And again, lots of my clients, when they initially come to me, are doing lots of these things in isolation, some not at all, but lots, some in isolation. But just tracking your spending again is not generally the thing that makes it work in isolation because generally it just shows you that you're quite good at spending money. There it goes, there it goes. It's making sure that you capture that really intentionally and are really directive in terms of where you put that cash flow. And again, for us, with our clients who have home mortgages, and I should caveat that when we were talking about investment debt, slightly different layering in terms of strategy. We're talking about home mortgages. You want to make sure that you have a really refined, optimal mortgage strategy. And we've talked about that just in terms of for us, we kind of calculate that down to the dollar in terms of interest rates, etc. But that flexibility is so important. Futures promise to no one, and hasn't the last 5 years taught us that in terms of COVID, the economy? It's been tricky. But just because it's hard doesn't mean we don't try. It's actually the reverse. It means that we lean in and we be better. And how do we be better? We be better with more optimal strategies. And I tell you, there are rules around all of this. You understand these rules, you execute on them, you teach them to your family. And again, your whole financial trajectory shifts. So that flexibility is super important. And again, we're going to unpack that soon in terms of not being tied to a really short term in terms of higher repayments, because that can scupper you elsewhere. And I want to kind of unpack this firstly with a wee example of some clients that I've worked with, just to bring this to life. So these are lovely clients, Peter and Natalie. Um, I don't have a typical client. Again, I've been doing this for the last decade. My youngest client is 24, my oldest client is 84, and everyone in between. So Peter and Natalie, gorgeous couple, 44 and 48. Their mortgage is 239K. When they initially came to see me, they were due to pay that off in 21 years, ages 65 and 69. So immediately we have an issue in terms of they have to work longer than 65 to deal with this mortgage. And I think for lots of people, their whole strategy in terms of sorting retirement is often anchored to, well, do you know what? I don't so much care about my mortgage because it totally is. This mortgage is small in comparison to many people. Same principles apply, Brian, they really do. And for lots of people, no matter what the quantum is, that can be quite a heavy burden for them. And so when they initially talk to me, they're like, do you know what? We're not so worried about our mortgage because we live in Auckland, we'll just downsize our home. We'll just move outside of Auckland. And again, that will solve everything. It, in all reality, it doesn't, though. When push comes to shove, when I see this often with people who that is their only strategy, it's really hard to move out of Auckland at that point in time, for example, because that's where all your support network is, etc. And often it's not quite the thing that makes this work because, again, you think, well, I'll downsize my home. But then when you downsize your home, there's more people competing in that market in terms of that cheaper property. So you pay a little bit more than you anticipate. And when you sell your bigger property, you don't get quite what you expect from it. So again, never quite the thing that sorts retirement. But for these clients, and again, I know that 239K is small, but again, same principles apply. And so for these clients, their trajectory was 20 years. I said that being purposeful, making sure we find that surplus, increasing that cadence of saving by 15% and channeling that against the mortgage, you can have that mortgage term. What does that mean to them? In all reality, they've been working with us for quite some time now. Um, I originally said I'd get you mortgage free in 6 years. We actually did it in 4.5 years. Same principles apply to bigger mortgages. Again, it's increasing what you think that you're capable of, but along the way, it is not just focusing on one thing. I know I'm talking about mortgages within the context of this presentation, but again, that should open yourself up for other concurrent strategies in terms of what else you should be doing. So how did they do that? They had really good money habits, that really good cash flow management, great structures, that correct mortgage structure. They track their spending, and often working with an external expert, you do better. Of course you do. You always lift your game, you do what needs to be done, and you get there in the shortest amount of time. But for these particular clients, again, the focus isn't just on being mortgage free. What else have they achieved? They bought an investment property that settled in 2021, managed to go on an overseas holiday, purchased a car that they really, really wanted, and they did some minor renovations on their home. So again, paying off a mortgage is one part of a greater strategy in terms of really sorting your own position, in terms of opening up more options to do other things. And please know that we are focusing on mortgage strategy. Again, that's the construct of this presentation tonight. For all of my clients, we have a concurrent strategy where we clear debt and grow our wealth at the same time to land where they need to. And there's no greater time to start than today. I love that saying, best time to plant a tree was 20 years ago, second best time is today. And again, for some wealth creation strategies, when you are again being really optimal in terms of that mortgage structure, creating equity, you actually have a window of time to execute on other wealth creation strategies because the window of time closes quite quickly. And again, being mortgage-free unlocks options in terms of equity to potentially buy another property and leverage. Again, that's the second wonder of personal finance. You put in your money, the bank puts in their money, and you keep 100% of the gain. That's why investing in property is so important in the context of a broader plan for lots of people. Not to say that that's the only thing my clients do, but again, as part of that holistic overall plan, we really need to understand, well, what are your options and what's going to deliver what is needed in the context of your goals. And often, in terms of, again, paying off that mortgage, it just creates other opportunities to do other things. And I think you should be taking this opportunity to reassess what you're currently doing in terms of mortgage. And these are the questions that we're often thinking about in the context of my clients' plans. Should I refinance to another bank or stay put? Should I fix or float? And again, there's not one universal answer that's correct for everyone. We'll go through principles in a minute. If I fix, how long for? Um, some of those longer term rates, the curve's inverted still, so the longer term rates are cheaper than the shorter term rates, which means that for often it's really attractive for lots of people to fix for longer term, but obviously there's less flexibility around that. Doesn't mean it's wrong for everyone, but again, you really need to understand what's the right structure for you. Um, how should I structure the rest of my mortgage? How fast can I be repaying that mortgage? So again, there's lots of mechanisms to pay off a debt faster, but I am particularly interested about one mechanism. I want to understand what people are currently using in terms of audience. So, do you have a revolving credit? Yes, I do. No, I don't. Or I don't know what a revolving credit is. If you could just share that with me, please. And again, we'll just, if we need to, we might dive a little bit deeper in terms of how that could be useful or not for lots of people. So, we're going to dive into the 3 R's now: refix, refinance, or restructure. So, again, there's lots to being better for in terms of mortgage. Catherine's just said, I'm ineligible at this point for a revolving credit. So I'm presuming you're ineligible because your LVR is too high, I'm presuming. And again, one of the, yep, Catherine, and lots of clients initially come to us and they are constrained by that LVR piece, particularly for my clients who have first home buyers. I don't know if that's you, who have bought, particularly in regions that saw a sharpish drop in terms of, yeah, again, not alone, Catherine, and in value in terms of their property. I actually saw 2 clients this week from the Wellington region who'd bought first homes recently and experienced that drop in equity. If it makes you feel better, again, not alone. And how I look at that it's a paper loss. It doesn't mean it hurts any less, but it is a paper loss. And property is a long-term wealth creation strategy. You buy the right one for you and have the ability to hold it. Um, Values will come back. And again, it's just making sure that you can hold your line. And Catherine, do you know what this is about as well for you? It's making sure that you take that power back. You can't control the market. What you can control is having surplus funds to attack that mortgage faster. So you're effectively going to create and force the hand in terms of equity. You're not going to sit back and rely on the market increasing, which it will in time, but that's what we can't control. We're going to take the power back in terms of making sure that we have cash flow to force down that position by hook or by crook. And again, longer term strategy. Um, It was to do with how much deposit I had. Yep, that is true, and for lots of people. But again, our goal would be initially, and again, you might be working with a coach at the moment. The goal will be to get you to that 20%, where again, interest rates, you lose that low equity margin, and again, there's just other things we can do, and again, you're just not paying so much in interest. So, in terms of refixing, so lots of people, when they come to the end of their term, they will look to refix, generally at their existing lender. So, again, their mortgage will come up. And this is initially the question that brings a lot of my clients to me. Their fixed term is just about to come up, and the answer they would like me to deliver is, how long shall I fix my mortgage for? And of course, I answer that in the context of our initial session, but there's actually generally a broader question at play in terms of, yes, we'll understand that mortgage strategy, but at a higher level, how do we make sure that we have a strategy to pay the darn thing off? That's more important. And what will that facilitate for us in terms of our longer term plan, in terms of retirement, having children, etc. So again, important to know how long you should fix a mortgage for. But again, having a better strategy is the thing that we anchor ourselves to in terms of focus. And so lots of people right now are fixing or choosing to float, um, because obviously we're kind of in that falling interest rate environment, hopefully. Again, don't have a crystal ball. And so people are punting that they can pay a higher premium to float, hoping that they'll be able to hold on and bank a cheaper rate if they hold on. And some people are fixing for only 6 to 12 months, paying a bit more of a premium than to fix for longer term. Again, that can be really attractive and the right thing to do for lots of people. Your surplus has got to allow that. And that's often what you might be doing if you're thinking of selling your home, for example, as well in the imminent future, because again, got to be really careful at this edge of the cycle because this is when break fees come into play in terms of you fix for 2 years and you might choose to sell your property. Interest rates have fallen to break that 2 year term, that will cost you. And again, that plays into design in terms of mortgage strategy. And often people negotiate with their bank in terms of they want to, get that least amount of interest in terms of whatever term that they choose to fix for. Um, Lots of people in this particular market are looking at opportunities to refinance that lending to another bank. For most of my clients, they will always ask me, in the context of their plan, Katie, what's the best bank to be with? In all reality, I'm completely indifferent to what bank my clients are with. In my mind, there are slight nuances, but a bank's a bank. The important thing for me always, and I know I seem to be going on and on about this, is having that really great structure to pay it off. What that might afford people is the opportunity to completely restructure that lending in terms of terms. So they might have had that property for quite some time and that term is quite short. It's an opportunity to potentially kick it out in terms of total term, but also really design that structure to give you a little bit more flexibility and often refinancing to another bank. And obviously, Catherine, that is generally LVR dependent. But those who have that equity in that home, often by refinancing, you'll get a cash back about 0.8%, thereabouts, of the loan balance you get back in terms of cash back. And again, those funds can help mitigate those higher interest rates that we're experiencing still at the moment. And again, often having that chance to refinance, to get that kind of term kicked out, to be more optimal in terms of structure, that actually can often open up opportunities to invest in terms of other property, etc. Because again, you improve that serviceability piece in terms of kind of what comes next. And that third R, which again, I would say I would put into play for 99% of my clients who have mortgages, and some don't, some do, but for 99% of my clients, we're really making sure that we restructure that lending, whether we're keeping them at the same bank or to another bank. We're making sure that we have that really refined strategy. Often there's lots of inefficiencies initially, so often people will come to me with savings, and with that savings, my preference always is, particularly when you have a home mortgage, that those savings are offsetting debt on the proviso that you can re-access it going forward. And again, that re-accessing piece is really important because that's your resilience. But again, you want to be really interest efficient in terms of opportunities to execute on other wealth creation piece. So for 99% of people who come in to see us, we are looking at, well, how do I really refine the structure that I'm executing on? And again, there's pros and cons of all different structures and strategies. Obviously, I know what works, but everyone is different. And again, if any of this is resonating with you, there are great general principles, but you've got to catch what's relevant to you in terms of your own personal circumstance. And for most of my clients, they do an element of floating within a revolving credit, but also kind of balancing that out in terms of certainty around having that fixed term. And in terms of that fixed term, you're able to pay off often 5% without fees. If you want to pay off more than that, sometimes those break costs, particularly at this edge of the market, um, can be cost prohibitive. But again, we do the math. Um, Often people might again arbitrarily shorten the term of their mortgage. Again, love to get people mortgage free, but that flexibility element's so important. Again, lots of my clients are coming to me at the moment in terms of redundancies, etc. Again, I know particularly my Wellington, and I've got clients up and down the country, but I know in particular there are certain pockets of industries that are hurting, particularly my Wellington clients, etc. More often than not, there are restructures, etc. So it's vital that we have really good buffers in place, and often we put them within that mortgage structure. Again, for most of my clients, having that optimal structure in place is a risk mitigant. And again, it's about being really directive in terms of paying it off as fast as possible, but making sure that you balance that out in terms of flexibility. I saw your comment come up in terms of I'm a good saver, I use an offset. Fantastic. I work with lots and lots of savers. Um, Lots of shoppers, but also lots of savers. And my job is never to tell you how to save money. You are great at that. More, it's making sure that your natural ability to save, you're using that to the best of your ability in terms of being as resilient as possible, but also looking at other strategies that you should be executing on along that journey because you can't save yourself to wealth. And you mentioned in the chat an offset product. So again, lots of people might be using them in the audience. Very similar to a revolving credit. So a revolving credit is like a big overdraft that's floating. And to float, you pay about 1.5% higher than you would be to fix. So revolving credit, like a big overdraft. For my clients, when we are being optimal, generally what sits in that revolving credit is a savings or debt reduction goal for the next 12 months and what we could offset in terms of savings. Anything over and above that, we're going to fix to pay, again, the least amount of interest. They're useful because if you pay it off within a calendar year, you effectively halve the interest rate that you pay. So, for example, if you're floating at 8% and you pay off that revolving credit in a calendar year, the effective interest rate is 4%. Why is that? You only pay interest on the amount that you owe, not the available balance. Very similar to that offset product, which is not all banks offer it, but many do. An offset is, again, I had a client come to me recently. They had, they said, I'm mortgage free. I have 300,000 floating in an offset that I owe to the bank, and I have 300K in a savings account. So great, they were paying no interest because they effectively offset each other, but they were still paying that 300,000 off over the term that they had left. I don't like that. I don't. I think that's a really ineffective way to use cash flow because, in effect, in my mind, if it's paid off, you should be channeling that surplus funds into wealth creation and investing versus paying off something that you're not effectively being charged interest. Versus if that same client had a 300K revolving credit, they plonked in those 300, they sell 300, oh, say that fast, 300,000 in savings. They offset the revolving, so they owe nothing. They can still reaccess it, but it's zero in terms of cash flow. So again, they're using that excess cash flow in terms of wealth creation. So they're investing to really maximize their returns via property, managed funds. I never care. It's what will serve my clients best. A lot of my clients will invest in property. Why is that? Again, just because you can leverage outperforms other asset classes by 250%, not because it's amazing, it's because, again, you can get returns on a bigger asset. Again, that's why lots of people will lean into property in the context of your plan, but you can't do that infinitely because as you get older, really hard to get lending from the bank. Um, Again, you can see, and it can work really well for some people in some circumstances, that offset. It's just, again, understanding what's available and what will work for you in the context of your plan. And again, we are experiencing, I mean, they're still high. Remember, we're still not back to 3% LVR, OCR, so many acronyms, I'm sorry. So we're still in that tightening environment. But it's paying off your home debt is one of the most risk-free things you can do in terms of your finances. Not the only thing, but certainly one of the most risk-free things you can do. And the math around that is, if you're paying 6-ish% on that mortgage, you kind of add back the tax that you pay, you would have to be getting at least 9% consistently after tax and fees to make it more worthwhile to purely invest versus paying off a mortgage. So again, really important in terms of the context of your plan. And I know I've been using that plan word a lot. It is vital to have a plan. And I actually think that's one of the biggest obstacles for New Zealanders. We don't have a plan. We don't know what we're capable of. And I think in the absence of not knowing, we kind of do what we've always done, hoping for the best. And it's fantastic that you've come along today. I hope you're learning really good things. But again, it's not only learning these things, it's that execution base so important and understanding what else you should be focusing on. Because there's that KiwiSaver piece, there's that wealth creation piece that I'm trying to touch on. Really important lever in terms of your mortgage strategy. But there's other things you need to be thinking about. And having a plan, it just gives you direction and focus. Um, it often that accountability piece is important. Again, it's kind of akin to being healthy, losing weight, etc. It's what you do every day that counts, not flash in the pans. That's what really moves the dial. And again, if you ask me what my clients' universal goals are, and there are nuances, of course, there are nuances, and everyone is different. Everyone has a different plan. They really do. But in my experience over the last decade, in terms of Enable Me, and again, I've been in the financial sphere since I left uni, but I think for most people, their goals come down to two things. They want security They don't want to worry about money anymore, and they want more financial freedom. They want to have more choice around the work they do, how long they work for. That's generally the driver for the vast majority of my clients. And a plan does not mean that you do it once and you lock and leave. If my clients' plans were locked in concrete, it would quite quickly become irrelevant to them. Again, change happens, future's promised to no one. You've got to be light on your feet, but not knowing what comes next in terms of redundancy, sickness, um, doesn't mean we don't try or we don't execute. What it means is we need to make sure that whatever we do is optimal for where we are right now. We always where our feet are, and we focus on, well, what's the next right thing and the next right thing and the next right thing. It shouldn't prevent us from taking action. And again, I hope you've caught that for my clients, it's about, well, how do I live my best life, not smallest life? And again, we always celebrate progress. And I think often it's so important just to acknowledge, well, this is where I'm at now. Where do I want to be? But you again, you celebrate along the way because again that's what life's about, understanding that you are moving forward. I think often understanding that starting point is really important, and again it often keeps you motivated to keep doing what needs to be done. So again, best approach, different for everyone, to be honest. Again, in terms of design of plan, we've been talking about mortgage strategy comes down to time frame, your goals, your risk appetite, capacity for risk. Everyone has different cash flow requirements. Flexibility, super important. Age and stage in terms of access to mortgage lending. And again, Catherine, we've said, I'm constrained in terms of the deposit that I had. That's okay. Again, we just work really hard to make sure that we get that equity up in terms of that house, and you drive that. Because again, unlocking what comes next is really important in terms of that overall wealth creation strategy. And again, got to review that consistently. So often I have these really awesome clients. They came to see me, and I've worked with their brother for years and years and years. Anyway, they came in and they slapped their hand on the desk and they said to me, "I hear you've got a money tree. We want a piece of this." And she kind of slapped her hand on the desk. And I'm like, oh, I don't know if we've got a money tree. But again, there are rules around all of this. Your mindset's really important. And for most of my clients, it's about being in control, having a plan. We always face forwards. Shadows fall behind. We're focusing on what we can control. Again, maximizing that forward momentum. Money's not good or bad, but again, when you focus on it, you just feel like you're in control of your life. And again, knowing all of this, really important. You might listen to podcasts, you might read, etc., come to webinars. It's all awesome. It means absolutely nothing if you don't take action, though. And again, there are windows of opportunity. We haven't covered what the OCR means in terms of other wealth creation opportunities. Um, Easier to get lending, tester rates coming down. If you have savings, it means you've really got to look at that strategy in terms of, because those interest rates are coming down, please be more productive. But again, when you are focused on what's important, it just will unlock doors faster. It just does. In terms of what we do for our clients, and we're really proud of the results that we help our clients deliver. Um, but for me and my team, it means that we diagnose your starting point, identify where you need to land, and again, I want to make sure that you have the biggest landing pad possible. Assess your capability. Everyone's got different capabilities, and we design a plan to unlock your potential. One important pillar is that mortgage piece. Not everything, but it is really critical for most people. And again, understanding what you're capable of and unlocking that, your trajectory shifts. It just does. Not only when it comes to mortgage, but that broader wealth creation question. And again, lots of people think the thing that fixes this is just to earn more money. It's just not. Again, it's how do I channel what's left over as productively as possible? And I think for my clients, again, having that help to execute that plan, building up that buffer, being accountable, again, just means that you get that consistency going forward. Key takeaways: becoming mortgage free unlocks financial freedom. It just does. You can argue as long as you want. To me, it unlocks financial freedom. But remember, there's good debt and productive debt. Most people aren't on track to be mortgage free by retirement. So, again, 51% of you are. Great. You can't eat your house. So you need to be doing something else. So I'm going to challenge you on that. You can't count on interest rates. They're the uncontrollable. You control strategy, and that's what we lean into. Um, Again, get advice, get a coach to keep you on track, celebrate milestones, and stay focused. Um, Again, for lower income people, again, it's really not what you earn for most that makes this count. Because again, in all reality, the more that you earn, the more that you spend, and the more you disconnect from your finances. It's making sure that you're really intentional with what's left over. And again, if you are constrained and you've done everything that you can, again, we try and focus on that income lever in terms of, well, how else might I earn? Is there side hustles? Can I get a boarder in? Can I mitigate my accommodation cost so that I can get ahead? There's always options available. So I mentioned at the beginning, love to invite you along. If any of this resonates with you, and you're not one of our lovely Enable Me clients, I really would encourage you to come along and have a 90-minute session with a coach like myself. What that will cover, if you have a partner and your finances are combined, please come together. But essentially, you jump on the financial scales, we figure out where are you at now, where do you want to be, are you on a track, and could you do better? Obviously, we cover off that mortgage structure and strategy, but I'm going to look at that other wealth creation piece for you as well. I just cannot not, because again, that's part of how do I really maximize. So we've got a special one tonight for attendees. So that 90-minute session, it's usually $400. If you book tonight, that will be discounted to $149. And if you're watching the recording, sorry, tonight is October the 9th. If you do watch a recording after this date or you reach out to us after tonight, it'll still be discounted, but to 249. One night special of 149, so that's usually 400. So questions, I'm sorry I've not left much time, but I can talk fast, so hit me.
All right. So our first question is, which strategy is better for paying off a mortgage? Increasing weekly payments or doing lump sums at the end of fixed terms?
Neither. So what I would do for my clients, as we've discussed tonight, my preference isn't increasing the cadence of repayment. It's actually paying the least amount on that fixed term and having a goal that we're striving towards in terms of debt reduction, generally sat within a revolving credit. So immediately as we have surplus funds, we are offsetting debt on the proviso that you can reaccess it. That's what works.
Right. And then another question is there a good is it a good idea to break the mortgage loan into two or more portions?
Depends. It really depends on your strategy. For lots of my clients, they do have layers within that mortgage structure. Again, we'll have a goal that we're striving towards if there's surplus funds. And then generally, we might fix over certain periods aligned to their goals. So for example, if they're going to sell their house, then obviously that plays into our thinking. And for some people, that's a bit of a risk mitigant, but everyone's different.
A question that has come up is from a longer term wealth perspective, would you recommend becoming mortgage free on your first home before potentially moving on to
No.
another more expensive property requiring a new mortgage? Or is it better to start off with that bigger mortgage and start repaying as soon as possible?
Um, how I heard that question is, do I have to wait to be mortgage free on my home to start investing? No. If you do that, often the cost to you of that is that you miss out on the capital appreciation of another property, essentially. So again, for most of my clients, again, we're always focused on being mortgage free as fast as possible because that's unproductive debt. But we're looking at as soon as they have capacity to do so, we extract that equity to have another property bubbling away in the background. If you focus on, again, not doing that, cost to you is that you're not effectively using that equity. So again, it's that concurrent strategy in the context of your overall plan.
Right. Last question. It's asking about offset mortgage versus revolving credit. Is there a point where one of them is more preferable than the other?
Yes, I for most of my again, this is, I'm disclaiming everything I say tonight because again, not individualized advice. For most of my clients, the preference is the revolving credit because again, when it's offset, there's not a cash flow payment, which is true within an offset product. So generally, my preference for most of my clients is the revolving credit, knowing that everyone's different.
Great. Thanks, Katie. I'll let you close off.
Amazing. So again, I hope you really enjoyed tonight. Again, I hope lots of it resonated. I've tried to be really direct. There's so much we could have covered off. Again, I've gone over time. That's just what I do. Sorry, again, didn't want to leave anything out. Great news that the interest rates are coming down, but the thing that will move the dial for you and your family is having that really effective optimal strategy. Again, really encourage you if you'd like some help around that, just to dig deeper, please reach out. Just it's a great special. And again, I think understanding capability and capacity is really exciting for most people. Do not accept the default position of New Zealanders because it's just unacceptable. Okay, all the very best. Take care.